FDIC Chair Sheila Bair speaking here in Washington just a short time ago, talking about the latest health of the banks, the latest report card from the agency on the nation's banks. 552 now considered problem institutions. That number moving higher in the third quarter. James Chessen is the chief economist of the American Bankers Association. He was listening in to Chairman Bair just a short time ago. He's live at the FDIC now with his take on this latest report card. James Chessen, thanks for the time. Appreciate you joining us. And what do you take away from this latest report? Is there more good news or bad news in it?
Well, I always try to look on the bright side of things, so I think it's reasonably good news. I mean, we're in the middle of things. It's a tough position to be in, and obviously the industry has problems to work out, but the industry made money. The capital to assets ratio is the highest it's been in 19 years. Banks are aggressively setting aside reserves for the future because they know 2010 is going to be difficult. So I think the banks are positioning themselves to be stronger next year and continue to build on their loan growth.
But that 552 figure, that's got to be a troubling figure for the industry. I mean, you've got a lot of banks that are right on the edge right now.
Well, it's always painful to see banks are on the problem bank list, you know, but the important thing to remember is the majority of banks that end up on that list don't fail. The FDIC is very good about helping them get back to health. They are raising capital. They can merge with other people. So I'm not sure it's the biggest indicator of problems, but of course it's always troubling when you see more banks that are really struggling in their communities.
We've got $62 billion set aside by these banks, by the industry, these FDIC-insured banks for losses going forward. Is that enough?
Well, you know, I think the industry is certainly prepared to do what it needs to do, both to build capital, to improve loan growth, and to make sure that the FDIC is very secure. Remember, the FDIC will raise $45 billion from the industry in cash at the end of December. So I think the industry is on an improved path, and I think the FDIC will be financially healthy.
James, you mentioned the FDIC being healthy, of course, but what about the banking sector? I mean, I heard you allude to comments that it seems to be strengthening. We had a guest on with us this morning saying next year is still a cleanup year. Do you have any sense of timing?
Well, I think you're absolutely right. Next year is still going to be a difficult year, and I expect the fourth quarter to be also a difficult quarter, because typically in the fourth quarter banks are more aggressive in putting aside reserves. They're more aggressive in charging off for the fourth quarter. So don't expect the fourth quarter to be great, but I think that helps to position the industry for a better 2010, realizing that we are going to have next year unemployment still above 9.5%, perhaps even 10%. It's a difficult environment in many communities around this country, and banks are a reflection of the communities that they serve.
James, you talked about that $45 billion in prepayment that the banks are going to put in to try and shore up the reserve fund, the FDIC deposit fund. Do you think that's the end of the line there? Do you think they're going to be hit up again, those banks?
Well, I certainly hope that that is the end of the line. I think the FDIC is being conservative in that approach. They obviously are worried about having losses, but it's a big commitment for the industry to put that kind of resources to the FDIC, what they would have received over the next 3 years. So I think it's going to be enough, particularly when you have the economy improving, when loan growth will be improving. I think it's going to be enough. That's certainly my hope.
James, to what extent are we going to see consolidation in the banking industry? I mean, some people have said that TARP has delayed what is sort of natural course of events, if you like. Is that a good thing or a bad thing?
Well, I think there will be a natural consolidation. I think, you know, there was a need for capital into the system. There really is a desperate need to get capital into smaller banks. What the capital purchase program of the TARP did was put money into the larger banks, and it was very slow to roll out to smaller banks. We need capital in those small banks because they are serving communities that really need that loan volume, and it's harder for smaller banks to raise capital in this market.
James, as Sheila Bair was also asked about the legacy loan program, do you have any sense that that's really going to be successful? Is it that needed right now?
Well, I think they're trying. I think it will help. Anytime that you can try to get some of the bad loans off the books, any kind of way to facilitate that will be helpful. But I think it continues to be dragged down with some of the problems. We're very hopeful that we'll be successful. There's no question that any way you can get assets off the book, help clean up that portfolio, is going to be a good thing.
James, we thank you so much for your time. James Chessen, Chief Economist at the American Bankers Association.